Hey everyone, welcome back to Corporate Decoder. Today we're diving into a financial report that has got more numbers than a Las Vegas casino, and frankly some of them are about as predictable as a slot machine. We're sifting through the latest filing from the FPA New Income Fund. Stick around because we're going to translate all this financial jargon into plain English, figure out if this fund is a solid bet or a risky gamble, and see what these numbers really mean for your wallet. And hey, if you like getting the real story behind these corporate documents without the fluff, make sure you are subscribed and hit that notification bell. Come join our Discord community. The link is in the description below. It is where we break down these filings even further, and you can ask your questions directly. Alright, let's get started. This report covers the FPA New Income Fund up to the 30th of September 2025. It is essentially a look under the hood at where this investment fund puts its money and how well it has been doing. First up, let's talk about costs. For a hypothetical $10,000 investment in the FPA New Income Fund institutional class, the expenses for the year were a mere $46. That is about 0.45% for the investor class. It is a bit higher at $56 or 0.55%. Not too bad, but every little bit adds up. Right? Now for the juicy part, how did the fund actually perform for the year ending the 30th of September 2025? The institutional class saw a net return of 5.00%. The investor class was just a hair lower at 4.93%. Not bad, especially considering they're playing in the bond market. So what made the market move for this fund? Apparently treasury yields went down for shorter terms, but up for longer terms. Spreads on debt also decreased, meaning it was cheaper for companies to borrow money. Because of these lower spreads, the fund focused on longer term, high quality bonds. They also reduced their exposure to lower rated debt because it just wasn't looking attractive enough for the risk. They mentioned their fund's duration, which is basically how sensitive it is to interest rate changes, went from 3.2 years to 3.3 years. Not a huge jump, but it shows they are slightly leaning into longer term investments. What really helped the fund's performance were things like agency guaranteed residential mortgage pools, corporate bonds, and asset-backed securities backed by equipment. The only thing that really hurt them was asset-backed securities backed by credit card receivables. So while some specific investments may have dipped, the overall picture for their investments looks mostly positive in those key areas. Let's look at the big picture of growth for the FPA New Income Fund institutional class. A $10,000 investment grew by 5.00% in 1 year, 3.23% over 5 years, and 2.88% over 10 years. The benchmark, the Bloomberg US Aggregate Bond Index, performed worse over 5 years with a negative 0.45% return, but better over 10 years at 1.84%. It is interesting to see how different parts of the market perform over different timeframes. Let's check out some key numbers. The fund's net assets are a massive $10,288,577,158. That is a lot of money. They hold 358 different investments. They paid out over $33 million in advisory fees, and the portfolio turnover rate, which is how often they buy and sell their holdings, was 41%. That suggests they are not constantly trading, which is usually a good sign for a bond fund. Now, what are they actually invested in? The top holding is a US Treasury note with a 3.875% interest rate maturing in 2030, making up 11.5% of the fund. Then we have more US Treasury notes followed by some corporate entities like Phi Group Incorporated and Fortress Credit Opportunities Limited. It is heavily weighted towards government backed debt and some larger corporate names, which generally points towards a more conservative investment strategy. Let's really dig into the schedule of investments. This is where we see the nitty-gritty. The fund has a massive 91.2% of its assets in bonds and debentures. A big chunk of that, 28.2%, is in asset-backed securities, with a lot of that being in auto loans. We're talking about hundreds of millions of dollars in auto loan trusts from major car manufacturers. Then we see a significant portion, 14.9%, in commercial mortgage, backed securities, mostly from US government-sponsored enterprises like Freddie Mac. This means they are invested in pools of mortgages on commercial properties. And then a very large chunk, 29.1%, is in residential mortgage-backed securities. This is a huge part of their strategy, investing in bundles of home mortgage loans. This is where the action is for this fund. Finally, they've got about 17.1% in US Treasury notes and bonds. This is the safest bet in the bond world, and it makes sense they allocate a good portion here for stability. Looking at the statement of assets and liabilities, their total assets are over $10.3 billion, and liabilities are around $18.9 million. This means they have a very healthy net asset value of over $10.2 billion. The cost of their investments is about $9.9 billion, meaning they've made a decent profit on the paper value of their holdings. The statement of operations shows they earned over $427 million in interest income alone. That is the pure income from holding bonds. They also had gains from investments totaling over $62 million. After all expenses, which are around $53 million, the fund saw a net increase in net assets from operations of over $453 million. That is a strong showing, especially when you consider they waived a significant amount of fees, which is great for investors. Digging into the financial highlights shows the per share performance. For the investor class, the total return was 4.93% for the year. The institutional class saw a 5.00% return. These numbers align with what they stated earlier. Interestingly, the expense ratios after fees waived and expenses absorbed are very low, at 0.55% for the investor class and 0.45% for the institutional class. This means the fund manager is really working to keep costs down for shareholders, which is a big plus. Now, the notes to financial statements are where you find all the important details. They explain how they value their investments, and a lot of their holdings are valued using models and observable inputs. But a significant portion, about 28.13%, are restricted securities that can't be easily sold. They also have a whole section on fair value measurements, breaking down their investments into level 1, 2, and 3 based on how easy it is to get a reliable price. A good chunk of their assets are in level 2, meaning there are observable inputs, but they also have some level 3 investments which are trickier because they rely on unobservable inputs, meaning more judgment is involved in their valuation. They invest in affiliated issuers, which basically means they invest in other related companies. They hold a significant stake in Phi Group Incorporated and have investments in AIPCF, the ABABL aggregator, Cayman LP. This can sometimes raise questions about potential conflicts of interest, but it is not uncommon in the fund industry. And lastly, the report includes an opinion from their auditors, Tate, Weller, Subai, Amp, Baker, LLP. They give a clean bill of health, stating the financial statements present fairly in all material respects. That is always good to see. So, what is the verdict on the FPA New Income Fund? The fund is a large, established player in the bond market. They're heavily invested in mortgage-backed securities and US Treasuries, which suggests a strategy focused on stability and income. Their performance over the year was solid, and the fact that they're waiving advisory fees and keeping expenses very low is a huge positive for investors. The biggest risk here is the sheer amount of money tied up in mortgage-backed securities, which can be sensitive to economic shifts, and the fact that a good portion of their holdings are restricted, meaning they can't be sold easily. However, the overall financial health looks very strong with high net assets and consistent income generation. It seems like a fund designed for steady returns rather than explosive growth, which aligns with its bond-focused strategy. Alright, that is our breakdown of the FPA New Income Fund's latest report. What is your take on these numbers and what they signal for the fund's future? Do you think being heavily invested in mortgage-backed securities is a smart move right now, or does it present too much risk? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And of course, make sure you subscribe and ring that notification bell so you don't miss our next deep dive. And once again, check out the Discord link in the description. It is a great community to continue the conversation. Thanks for watching, and we'll see you next time on Corporate Decoder.